there are business cycles or short-term debt cycles in which people want to spend, and credit is available, and so they take on credit, and that causes the short-term cycle where everything goes up. Markets go up when credit's available, everything goes up. And then when it gets overdone and you run into capacity constraints and so on, produces inflation, they tighten monetary policy, and you have those cycles. The credit system I think of as being like the circulatory system in your body that brings, like blood brings nutrients to different parts of your body. It brings these nutrients, the buying power. And if it's used well so that it produces income, then everybody prospers. So, the lender gets paid back, and the person who borrowed it and used it to be productive, it's great. And so at those times, you don't see debts rise relative to incomes. However, when debts rise relative to incomes on a chronic basis for a long time, it's like plaque in that system accumulating. Think of it this way. The more debt and debt service you have, the less money you can spend out of your income. So as it rises, right now for the U.S. government, it's almost $1 trillion a year that goes to interest payments. So it's sort of like plaque that narrows that, and it's a problem. There's also a supply-demand issue for credit, like every other market, so that when we have run a large deficit, and now the deficit's projected to be about 7.5% of GDP. When you run a large deficit, you have to sell debt to do that. And the quantity of debt sold has to come up against how many buyers are there. And when I calculate it, the quantity of debt sold to be sold is much greater than there is the buying power, the inclination to buy. So that's the second thing. The debt service payments having that problem, the problem in terms of the supply demand. And then you get into a dynamic when it gets bad in that debt service that you have to you can have selling of existing debt. And that's when you have real problems. Now, in the private markets, credit markets, we just talk about a death spiral. And a death spiral is that part of the cycle when the debtor needs to borrow money in order to pay debt service, and it accelerates, and then everybody sees that and they don't want to hold the debt. That's where we're approaching.
How soon before we get there then?
It's like if I was a doctor and I was speaking with you about your condition, I would say to you, this is now very, very serious. All of these are major problems. What you need to do is cut your deficit from about 7.5% of GDP to 3% of GDP. And you can do that. There are certain things that you can do that cut it in a certain way that'll make it much healthier. So the real problem is a political problem. So we could get into the mechanics of how that was done. It was done in 1992 to 1998 as an example. And it can be done, and it would be good for the bond market. It would be good for everything. But you have to keep in mind 3%. In other words, it's what I call the 3% solution. The 3% solution is that you have to get debt down to the deficit down to about 3% of GDP. And then also the important thing is that you can realize that you can get it from 3 factors. We think about 2. There's taxes, there's spending, but there's also interest rates. The interest rate on the debt is very high. And so when you cut the supply, you improve the bond market. In other words, it performs better. You'll get a lower interest rate. And when you get a lower interest rate, that's good for markets, good for the stock market, good for the economy and so on, which brings in other taxes benefits. So if you think about those 3 factors, in other words, I emphasize 3% of GDP with those 3 factors, that can be done. And if it's not done this time, I really worry. I think that everyone who's responsible for that, from the president to the Congress, should recognize They should take this 3% pledge, but recognize that if they don't get it down to that, that they are responsible for the consequences that will follow.
So walk me through what we can expect to see next here, and what is your message to the Trump administration, who is responsible for stewarding the US economy right now and managing that debt level when it comes to addressing this problem that you're highlighting?
I'd say recognize the problem, and I think they recognize the problem. And then in the actions that are being taken, how do you cut costs? How do you raise productivity? How do you make sure that the technology gains produce the incomes and the productivity to compensate for that? Make sure that you really know what you're doing and you're practical, and do it on on the conservative side, because how much can the cutting actually be? We'll see, and what are the consequences of the cutting, and each one of those. So you better take a sharp pencil and be conservative. The other thing about this is you have to do it when the economy is strong, because when you have these cuts in the budget deficit, it is think of that as a difficult experience, okay, because it's fiscal restraint. That will be balanced with monetary restraint, because the central bank will ease and the monetary policy will follow. But you need to do this now, is my main thing. Because if you do it another year from now or 2 years from now, you're going to accumulate that much more plaque. And you're going into the part of the cycle which is very, very risky. So, it's a tough job that you've got to do.
So if you're the doctor, where does the scalpel cut first?
I can't tell. Each has a different approach. I think this is the biggest problem. The biggest political problem is they don't have a number in mind. That's why I emphasize 3% of GDP. They don't have a number in mind. And then everybody's got their own particular way of dealing with this. And that's the political problem. So it can be dealt with. I think that if they put together a fiscal commission, or whatever way they get to the answer, take the pledge, 3% of GDP that they're responsible for, and then have perhaps a fiscal, whoever is responsible to get there, they have to get there. I don't want to let my own preferences for one thing or another. Everybody's got the preferences, and they're not talking about it. That would be like asking me, would I prefer exercise? Would I prefer diet? Would I prefer that? I'd rather not say, and leave it to those who figure out how to get there.
So Ray, you've done a lot of deep thinking on this issue. You've explained the mechanisms. You've outlined some of the potential responses. What's the lesson here for private investors exposed to either the equity or the debt markets in the United States or globally who are also thinking about this issue?
Well, you better pay attention to what's happening, because interest rates, the Treasury interest rate, is the backbone of all markets. It's the foundation of all markets and all economies. And we're getting into a period now where asset prices are becoming pretty high. This can look quite like 1998 or 1999, when asset prices rise. Back then we had great new technologies, the internet, the .com and so on, and that went on to be great. But pricing matters. And so when you have these high prices relatively high, and then you have a rise in interest rates, that can cause trouble. It's likely to cause trouble. So pay attention to actually literally what happens, and be careful about that. I would also say that, debt assets in one way or another probably are not going to be a great asset class. There's a lot of risk in the debt asset. People think of default risk, but there's the money and the devaluation risk, because there won't be a default. The central bank will come in and will print the money and buy it, rather than to let that default happen. And that's where there's the depreciation of money, the value of money. And so you have to think in real returns, not just nominal returns, and be aware of those risks.
Are you concerned today about valuations that we see in equities?
Yeah, yes. And I think I never remember a time in my life where the disparity of returns and necessary earnings growth to justify multiples, that disparity between sectors was so large. The United States pricing and all of that has become very, very large. And within the United States, those tech companies and so on have become very, very large. And I'm not saying they're too high, but there are, they may be. So when I'm looking at the pricing disparity, I am concerned. I think there's a lot of enthusiasm by the stocks that we all know, the Magnificent Seven and beyond that. I think the biggest tech impact, of AI, will be in the users, not necessarily the producers, to be able to change their cost structures, to be able to have the benefits of the efficiencies and so on. And I don't think they've received anywhere near the adequate amount of attention. So I would rather have be in those types of sectors if I'm playing that part. But I'm also, I believe a lot in diversification. I also think that people don't have typically adequate amount of gold in their portfolio. In other words, gold, if you didn't have a view of the market, like the gold market, it's a very effective diversifier under the other portfolio, because when bad times come, gold is a very effective diversifier. So I think that having something in the vicinity of 10% or maybe a little more, 10 to 15% in the portfolio is worth giving some thought to. And when I say gold, some people might say digital currency and so on. I own some digital currency. I own some Bitcoin too. But in other words, debt is money and money is debt. And we have a problem. We have a supply-demand problem with it. And so a good diversifier for a typical portfolio is that. We have a lot of people, a lot of the market is leveraged long, like long. Everybody wants everything to go up and then they get excited and then they get leveraged long. And that creates a position that could be difficult.